Most traders have been brainwashed into thinking that your entry is the most important part of the trade, but that is a lie. Two traders can take the exact same setup, the same stock, the same timing, the same entry, and one walks away with a home run winner and the other walks away confused and broke. And here's why. The difference isn't the trade itself, it's the way that you manage it. In this video, I'm going to teach you the same exact trading management model that my father taught me 5 years ago when I had zero experience. What he showed me was so simple and so powerful that it helped me start making money only 3.5 months into my trading journey, and I still use it to this day. So if you're tired of watching winning trades slip through your fingers, I highly recommend watching until the end of this video. And I'm not saying that for me, I'm saying that for you. This video is a game changer. Let's not waste any more time and let's hop right into the video. Before I get started, I want to be as transparent and as real as possible. And this is my Charles Schwab brokerage account. And over the last 7 to 8 months, from November 1st of 2024 to July 26th of 2025, I've made a little bit over $457,000 in my day trading account, which is a cumulative rate of return of 265%. And this is also considering I barely traded in June. I was actually traveling throughout all of Europe. And the reason I'm showing you this is to be real and transparent, and to show you that I actually make money with everything that I'm going to be teaching you in this video. If you want to see some more recent results, over the past week, on Monday, I made $1,965. On Tuesday, I made $1,533. On Wednesday, I made $1,471. Thursday, I made $3,539. And of course, Friday, I made $3,054. And this was this past week. And it was actually kind of a slow week considering earnings is just beginning. So I am anticipating a pretty good uptick in my results in August. You could be the best at identifying high quality setups in the market. You could be the best at entering those setups, but unless you know how to manage your position when you're actually in the trade, you're never going to see the results that you're looking for. In this video, I'm going to explain the importance of trade management. I'm going to explain why it is the missing link between you having good entries and you having a profitable trading career. And finally, I'm going to equip you with trade management strategies that you can begin implementing in your trading as soon as this video ends, so you could start scaling your profits on your winning trades. And what you need to understand about trading is that it's not about being right versus wrong. You could be right on a trade and still lose money. And you could be wrong on a trade and still be able to limit your loss. Trading is about getting paid for how well you can manage your risk, how well you can limit your losses, and of course, how well you could extract profit from your winning trades. And you could have two traders who enter literally the same exact trade, the same exact entry to the penny, and one trader can leave that trade with a massive winner, home run trade, and the other trader can lose money. And the difference between those two traders is how they manage the position. And I see lots of people online talking about finding the right entries, having the perfect entry model, but they don't talk about how to manage your trades effectively. And some of the most common mistakes that I see with beginner traders, especially with trade management, is number one, panic selling on retracements. This is when you're in a winning trade, it's going in your favor, you're feeling good, and then all of a sudden it starts to retrace. It starts to pull back and you are seeing your profit slip away. And what happens? You start to feel fear, you feel doubt, and all of a sudden you panic sell right here just to see that trade continue in your favor and hit target. And this happens because you don't have a system. You're entering, let's say randomly, and you're exiting randomly, right? Another really common mistake is having a huge winner turn into a loser because you don't know where to take profits. You don't know when to get out of the position and secure profits. This is sort of the same thing right here, failing to hold a winner. I see this all the time, especially with beginners, where they're making, let's say 20, 40, 60, 100 bucks on that trade. And instead of like letting the trade hit their target, they get out right away, right? And I think this usually happens because of self-doubt, because of succumbing to their emotions, where maybe they're not confident in themselves yet to really hold on to a trade. They don't know whether they're, picking the right setups yet. And as a result, they succumb to their emotions and they impulsively exit the position, or they impulsively even add to the position when they're not supposed to. Another very common mistake is not cutting losses quick enough. This is when a trade is approaching your stop loss or where you're supposed to exit and you don't get out. You freeze, you hesitate, you feel fear that you're about to lose money, and then the trade blows by your stop loss and continues against you. Now, the only way to fix these common mistakes, and it's actually pretty simple, it's to have a predetermined management system. What does that mean? That means when you enter into a trade, you know exactly how you're going to manage the position before it even hits your entry. And if you've watched my channel long enough to this point, you know that I stand for consistent input, consistent action will lead to consistent results. And there are way too many traders out there who randomly enter trades, randomly manage trades, randomly exit, and their input is completely random, and then they expect consistent results. How does that make sense? How can you ever find consistency if your input is random? It doesn't make sense, right, at all. So that's why you need a predetermined management system. So when you enter into the trade, you're not guessing what to do. You're not guessing, oh, should I take profits here or should I raise my stop loss there? You know what to do before you even entered into the trade. And you can even write it down on a piece of paper, put it on your desk or your monitor or your wall so you know what to do. And what you need to understand about trade management is that very small tweaks, very small fixes in your trading could lead to massive profit increases. I always like to show you guys on this channel that trading is very much, your progress and your results is very much exponential. It doesn't go linearly, right? Like it's not like the more time you put in, the more money you make. No, your progress is like this. It goes exponential. And you don't want to quit before this point right here. And in order to have that exponential kind of move, you might just be a few small tweaks in your trading management plan away from having that exponential rally in your trading. And there's ultimately only two outcomes that can exist when you enter into a trade. Let's go over outcome number one. Let's just assume that you just entered into a new trade. You've opened a new position and you've already identified your entry, your stop loss, and your targets for this position. And by the way, if you don't know what your entry, your stop loss, and your targets are for that trade before you enter into the position, you have a lot of work to do. You are not where you should be in your trading. And if you do need help with this, you need help with predetermined setups, I highly recommend watching my free 10+ hour course. It is genuinely better than most paid courses on the internet. It's going to build the foundation for your trading so you could actually identify high quality setups and you're gonna know where the entry, stop loss, and targets are going to be. So make sure you start watching my free course ASAP. It's in the description of this video. So you open up a new position, and let's say the trade doesn't work in your favor. You get in, it looks good, but the trade just doesn't work, right? Losing in trading is inevitable. You're obviously going to have losing trades at times. It's part of the game. So it doesn't work in your favor and it hits your stop loss. What do? You exit the position and you take the loss. There's no confusion here. There's really almost no management here. If you get into a high quality trade and it hits your stop loss, it hits your max risk for that position, I don't care what your emotions are telling you. I don't care what your inner thoughts are telling you. I don't care if you think that's about to go up or about to go in your favor. Does not matter. If it hits your stop loss, you exit the position. And there's really no management even required here because you already identified your stop loss before you took the trade, right? So that's really simple. You get into a trade, it hits your original stop loss, you get out, no questions asked. There's really not much management there. The second outcome is, let's say the trade actually goes in your favor. The trade is a winner and it's starting to approach your target. What do? Do you exit the entire position? Do you exit half of the position at target? Do you ignore target 1 and go for target 2? Do you exit some of it, right? Do you trail it? Do you raise your stop loss, right? And you have to be thinking to yourself, what if this trade continues even more in your favor, right? You don't want to miss out on potential profits by exiting the trade too early, and you need to have a plan of execution on what you're going to do if the trade approaches your target or starts to move in your favor. And that's exactly where trade management comes into play. So let's say the position is approaching your target and it hit your target, right? You honestly have 3 options here. You could take profits right here, where you just take 100% of your profits, you take the W and you move on to the next trade, and you don't really care if it continues higher in your favor, right? Number 2, you trail the position and you raise your stop loss. And this is really where trade management comes into play, and I'm about to talk about exactly what trailing your position is. Number 3, you take partials, where you, let's say, take 50% of profits here, and then you aim for a bigger target up here to see if the trade kind of continues in your favor, right? So you exit half of your position and you leave the other half of the position still in the trade, and then you end up trailing the rest of the position. So that begs the question, what does trailing your position mean? Like, what does that actually entail? And that's where trade management really comes into play, in my opinion. And trailing your position is just a fancy way of saying you're adjusting your stop loss. You're raising your stop loss if you're in a long, or you're lowering your stop loss if you're in a short. Now, your goal is to place your new stop loss, right? Because when you entered into the trade, you have your original stop, right? Let's say the trade's starting to go in your favor, then you raise your stop loss. And the goal is to raise it to a location where you're not going to get shaken out easily, but you're also maintaining a high reward to risk. So what does that mean? What is shaken out? Like, what is that term? So let's say, for example, you have a consolidation pattern like this, right? And let's say this is the pattern here, right? You have a low here and you have this consolidation. Getting shaken out is basically where, let's say you enter into the position right here. It hits your entry, and then it starts to pull back, and let's say you have your stop loss right here. It begins to pull back, it hits that stop loss, and then it just continues in your favor, and it actually continues, and the trade actually works. You getting stopped out right here just to see the trade actually continue in your favor, that is called getting shaken out of the position, where it hits your stop loss and then it continues higher in your favor, right? But at that point, you're not in the trade because it already hit your stop. And this happens to all traders, getting shaken out of a trade where it hits your stop and then it goes in your favor anyway. Now, let's say we'll take this same example. Instead of putting your stop loss here, let's say you put it here, right? And it hit your entry and it started to pull back. And let's say it pulled back to right here and then continued higher. Well, if your stop loss was here, you would have gotten shaken out. But if your stop loss was here, you would have stayed in the position and you would have actually realized the profits on this move up. Does that make sense? So depending on where you place your stop loss is going to impact the probability of you getting shaken out of that trade. Where if you gave this trade more room, you placed kind of like a larger stop loss down here, you would have stayed in the trade. But since you placed such a tight stop loss right under this base right here, it shook you out and then it continued higher. So the goal for us is to like trail our position, adjust our stop loss in a way where we're not going to get shaken out easily, in a way where you're allowing the trade the room to fluctuate, but you're also maintaining a high reward to risk. And if this is still kind of confusing, don't worry, this is all going to make sense once we look at some examples and once we understand the strategies that we could use for trade management. But all in all, guys, what I want you to understand about trading is that trading is not a science. Trading isn't something that you're going to read in a book, you do exactly what that book says, or you do exactly what another trader says, and you're going to make money. This is why I'm so against these like Discord groups where there's no live trading and they literally just call out plays and then they send you the management, right? That management, that trade, and the way that specific trader trailed or managed his position might be different from the way you should manage your position. Every trader is different. No two traders are alike. And this is what makes trading such an art. And I always tell my students that never just directly copy me. You don't want to do that. You could take the same trades that I take, but I want you to manage it the way that you think you should, the way that makes sense to you. Trading is an art. And in order to understand this art, you need to have your own personality and your own style. You are your own artist in a sense, right? Like when you see painters paint stuff, every painter is a little bit different because they have their own style. Same thing with trading. You're going to have your own management style, and that's fine. That's the way you figure out your trading personality and you figure out what works for you. Now, let's talk about the first way in which you can manage a trade, and this is called a pivot trail. This is when you adjust your stop loss from your original point to the next pivot. So what is a pivot? A pivot is just like it moves up, it drops, and then moves up. This right here is a pivot point where it moved down and then up. This is a pivot, right? So when you're raising your stop loss to a new pivot, you essentially get into the trade here. It moves in your favor. Let's say it actually hits your target, right? And let's say you get out, I don't know, 50% of your trade here. Great, you're out 50% in profit. You still have the other 50% of your position. It starts to pull back, it forms a pivot low, and from there you could raise your stop from the original point to that pivot low, because the pivot is basically a way of like the sellers tried to take control and bring prices lower, and then the buyers stepped up and they brought prices higher, thus creating this pivot. So you could actually move your original stop to that pivot point. So this is actually a fantastic strategy if you have an established uptrend. Like let's say you have an uptrend like this, right? And you're in this thing long. What you can do is just continuously raise your stop loss, right? So let's say this is your original stop right here. As soon as it starts to move up, it pulls back and then continues higher, you move your stop loss from this original point to under this pivot. As soon as it starts to move up, retraces, continues higher in the uptrend, you move it from this stop loss to under this pivot, and you continuously raise your stop loss. Let's say it's here now, you raise your stop loss once again, and then as soon as this starts to retrace and it breaks below this low, you exit right here, and that's going to be your trail. And you're essentially allowing the trend to continue higher in your favor. You're giving the trade the opportunity to make you more money by continuously raising your stop throughout the entire uptrend. So this is a really effective way of managing your position if it's an established trend. And the same thing applies if it's a downtrend, right? So let's say we have something like this, and then let's say we have something like this, okay? Where your original entry, let's say, is right here, stop loss here. Moves down, retraces, begins moving lower again. You lower your stop to this pivot high. Then it does the same thing. You lower your stop to this pivot high. Then let's say now you have a consolidation. Then the consolidation breaks down, continues lower. You could lower your stop to the highs of that consolidation. And then let's say again, right here, pivot point, lower your stop here. And let's say it starts to reverse. That means the trend has been broken. It's no longer a downtrend anymore, right? Maybe it goes sideways from here or whatever, or maybe it goes into an uptrend. Well, you're out right here. And you're still in the trade until the downtrend is broken. So this is really, really effective for trending markets. For a stock that just keeps going up and up and up, or even the market. Let's say the market is in a really established uptrend on the daily time frame, you can continuously raise your stop like that. And you give yourself the opportunity to realize more profits using this type of strategy, okay? So this is actually really simple. I feel like most of you guys should be able to understand this. And it's a very common strategy as well that I use all the time. But let's go over another strategy that's a little bit more, I don't want to say complex, because it's really not that hard, but it's a little bit more nuanced, right? And this is called bar by bar management, or a bar by bar trail. So I'm going to read this. It's going to sound confusing. And then once I show you it on the charts, it's going to make a lot of sense. So when your target is reached, like let's say this is your target right here, and you entered right there. Okay, so let's say that's target, that's T1, target 1, and let's say this is your entry. Fantastic. So when target is reached, trail the position to the prior bar's low. When I say prior bar, I mean candlestick, so the prior candlestick's low. So you're raising your stop loss when the candlestick has finished forming. So what does that mean? So it hits target 1 right here, right? This is your target 1. What you do, and let's say this is your entry. Let's say your stop loss is down here. This is your original stop. SL, that's stop loss. Let me actually zoom in a little bit. Perfect. Stop loss. And this is your OG stop loss, original, just so you guys understand. It hits target right here. From here, you can go bar by bar. So you raise your stop loss to the previous candlestick's low. So in this case, assets surpassing target, you raise your stop loss from this point, the original point, to underneath this candlestick's low. And then as soon as this candlestick finishes forming and this one starts forming, right, and it starts to kind of base here, right, from there you raise your stop loss from this point to underneath this candlestick's low. And then as it starts to break out, right, let's say it's moving up, you raise your stop loss from this point to this candlestick's low. And then you raise it to this candlestick's low. And as it's continuing in your favor, you're continuously raising your stop loss to every candlestick's low. In this case, let's say this is our new stop and it's continuing higher, we raise it again. After this one starts forming, and this one, or after this one starts forming and this one's finished forming, right, you raise your stop loss again to this bar's low. And then as soon as this one's finished forming, you raise it again to this bar's low until you get a red bar. It takes out the lows of that candlestick, and now you're out of the position fully. Does that make sense? So you're raising your stop loss to every candlestick's low as the trade is progressing in your favor, right? So you have moves up. Let's say these are all candlesticks. You raise your stop loss from here to here, then to here, then to here, then to here, then to here, until eventually it takes you out, and this is where you exit. And this is called bar by bar management. And as long as the current candlestick doesn't take out the prior candlestick's low, you're still going to be in the trade, right? So let me kind of draw that out. So let's say you have this current candlestick that just finished forming, and your stop loss is under it, right? As long as the next candlestick, right, doesn't like go down and take out the low of the prior candlestick's low, right, you're still going to be in the trade. Does that make sense? So you continuously raise your stop to every candlestick's low as the trade is heading in your favor. Hopefully this is making sense. It's going to make a lot more sense once we look at some examples, okay? And the same thing would apply if it's a short, okay? So if it's a short, it's the same exact thing. So let's say this is a candlestick, right? And it's progressing in your favor. The stop loss originally is here. Then you raise it to this bar's high. Then you raise it to, or lower it to this bar's high. Then you lower it to this bar's high. Then you lower it to this bar's high. Then you lower it to this bar's high. And as soon as it takes out the prior bar's high right here, you're out of the trade and you exit, okay? Does that make sense? So let's look at some examples, and it's going to make a lot more sense in just a second here. And in terms of trailing bar by bar, a lot of you, most of you guys watching this video are going to be like, okay, I get that, right? You're just raising, as each candlestick is formed, you're raising your stop loss to its low gradually. Great, but how do we know what time frame to actually do this on, right? Because different candlesticks are going to represent different time frames depending on what chart you're looking at, right? So when it comes to swing trading, it's really easy. I would trail it either 1 hour, 4 hour, 1 day, or weekly bar by bar. Okay, if you're day trading, it's a little bit more nuanced. You can either trail it 1 minute, 2 minute, 5 minute, 15 minute, or 1 hour bar by bar. Now, this is easy. This sort of management is easy. You just raise your stop loss to the prior bar's low. It's actually really straightforward. What's difficult about this is figuring out which time frame am I going to apply bar by bar management on, right? And if you want a tighter trail, meaning you want to secure profits more quickly without giving the trade the room to fluctuate, like let's say it's hitting target, you feel great about the position, you want to manage tightly. You don't want to allow the trade to go that much against you in an attempt to move higher, right? You want to trail it quicker. You want to take quicker profits. You're going to want to use smaller time frames with your bar by bar management. But if you want to give the trade way more room to fluctuate and operate in order to go for a much larger move or gain, where you're going to use the larger time frames for your bar by bar management. Does that make sense? So if you want tighter management, you want to take profits quicker, you want to secure your profits quicker, you don't want the trade to fluctuate or go against you that much, you want to secure your profits sooner, you're going to use the smaller time frames, like the 1 to 2 to 5 minute, to manage your position. If you want to give the trade way more room to fluctuate against you in an attempt to go for a much larger gain, or to an attempt to capture just way more profit, that's when you use the larger time frames, and you could use like the 15 and the 1 hour. Personally, I usually use the 1, 2, 5, and the 15. I rarely use the hourly for my day trading in terms of managing my position. Okay? So I just gave you guys a ton of information. Now let's go ahead and look at some practical examples, and I'll show you how to actually apply this. So every single example that I'm about to show you are actually trades from this past week. I didn't like cherry pick trades from like 5 months ago. These were literally setups that were on my watch list this prior week. The first one that we're going to talk about is actually the MAT, and this was just such a terrific trade and gap, right? So MAT, we're first looking at the daily time frame. I just want to show you why I even was looking at this trade in the first place. We had a beautiful gap down from here to right here. You could literally see the gap on the chart. I think this was because of earnings. I can't remember, but we gapped directly below the 200 MA. We gapped below this area of support. And it was just, and we were also gapping kind of below this move higher. So it was shocking the people who went long during this move up here. And it was gapping under the 200, which is an area of support, and also kind of gapping underneath these candlesticks. And it had just tremendous follow through. And I had a bearish bias on this stock going into the day. So I went to the smaller time frames to look for a potential setup. So a very obvious setup that I see is move down, move up, base, and this is literally a textbook sell setup. Textbook sell setup is a retracement within a downtrend. You get a move lower, you retrace. This is a sell setup, and you attempt and you essentially make money in the next move lower. Now, I teach the sell setup in my free 10+ hour course. So if you're not familiar with that term, you don't know what we look for in a sell setup, watch my free course. It's going to teach you all of this, and you could use this video in conjunction with my free education. Now, what would be the entry here? Entry underneath these entry bars, stop loss directly above. And obviously this continued lower. Now, let's say this is our first target right here, the prior low, and it hit target right here. Now, what can you do? You could take profits. Sure, take 100% of your profits. You're out of the trade. You made your money. Great. Or you can trail your position. So let's say this starts to move down. Now, do we have a pivot? Do we have kind of like a retracement up and then a move down? Not really. You could say this is a pivot right here, but it's really not a pivot, right? Remember what we talked about right here. Like, can you guys really find a pivot on this chart? Not really. We don't really have a pivot like that. So our best method of management is bar by bar. Now, let's say you go 5-minute bar by bar. It hits target right here, and you lower your stop from this point to, let's say, this candlestick's high right here. So you lower your original stop from here to right here. And let's say you continue to go bar by bar. This bar finishes forming, and then you lower your stop again right here. But you would have gotten stopped out on this green bar. It would have stopped you out just for it to continue lower. And remember what we call that. We call that getting shaken out. So if you went 5-minute bar by bar here, right, and you lowered your stop, you lowered your new stop from right here to right here, you would have gotten shaken out on this green bar just to see the trade continue in your favor. However, if you went to, let's say now, instead of the 5-minute chart, to a higher time frame, the 15-minute time frame, and you went bar by bar, well, the outcome would be completely different. So let's say it hits target right here, and you lower your stop from this point to this candlestick's high, 15-minute bar by bar. Well, let's say it's starting to continue lower. This candlestick finishes forming, and this one begins. Great, you lower it again. Now it's here. This candlestick finishes forming, and this one begins. You lower it again. This candlestick finishes forming, and this one starts. It's basically the same stop, right? Same thing here. You lower it here. This one stops forming. This one begins. You lower it again. You lower it again. You lower it again. Again, and you literally just continue to lower it, right? You could see that during this move lower, not a single 15-minute candlestick took out the previous one's high. So you're still in the trade until right here when this green candlestick surpasses the high, and now you're out of the trade. Now, by going 15-minute bar by bar, you were able to capitalize on this entire move lower versus if you went 5-minute bar by bar, well, you're getting shaken out, what, right here. And you're missing this entire move. Does that make sense, guys? So the art of managing is figuring out which time frame should I actually manage it off of. Should I give the trade more room to fluctuate? Like in this case, by using a 15-minute bar by bar management, you're giving the trade more room to breathe. You're giving the trade more room to fluctuate. And as a result, not a single 15-minute bar took out the previous one's high. So 15-minute bar by bar would be valid the entire way down until right here. By that point, you've already made your money. I think this was a 20-cent stop. This is like 7 to 8 Rs. If you were risking $200 on this trade and it went 7 Rs, you made $1,400 off $200 risk because you went 15-minute bar by bar, right? And this is the importance, and this is how trading is like an art. Managing trades is an art. Let's look at another example. All right, we'll start off with the daily time frame to establish the bias and understand the gap, right? So this is the daily chart. So we gapped from here all the way to down here. This was a pretty massive gap. It was actually gapping right into support. So I actually wasn't that aggressive with this one this past week, but nevertheless, it did produce tremendous follow through to the downside. Great, so it was a gap down, bearish bias. Let's look at the intraday time frame. So right here, we kind of have this like 5-minute base. This is not very nice, kind of sloppy. So I'm actually gonna go to the 15-minute time frame because this is where the setup really was. This is a 15-minute 1, 2, 3. We have 1, that's the igniting candlestick lower. We have 2, the resting bar, and then 3, the triggering bar. This is like a 1, 2, 3 play. Some people call it the ABC, right? And the entry for the 1, 2, 3 is under the resting bar's low, stop loss over the highs, and of course this continued lower, right? Now, let's say you enter here, it's going in your favor, and you wanna go bar by bar, right? There's no pivot here. I guess if you held through this, right? This is a pivot, and let's say it continued lower, you could have actually lowered your stop loss from this point to that point right here because this is a pivot, right? This is what we talked, this is the first strategy that we talked about. Then let's say it moved down, moved up again, move down, boom, you lower your stop loss from this pivot to this pivot. Same thing happens. It drops, bases, attempts to move higher, continues lower, then you lower your stop loss again to over the highs here. And by doing this, you're continuously lowering your stop, right? So it was originally here, now it's here, now it's there, now it's there, and you're in the trade essentially the entire day. The other way you could have done it is 15-minute bar by bar, where this one finishes forming, so you lower it to here. And then as soon as this one finishes forming, you lower it to here. And then, of course, you would have gotten stopped out on this on these green bars right here. Or what you could have done is done it on a smaller time frame, where the stop is right here. Then you go 5-minute bar by bar instead. This is the 5-minute chart. So you're using tighter management, right? Tighter management since it's a 5-minute time frame. So it's a smaller time frame. Remember what we talked about, guys? That looser trail, right? It's a higher time frame. You're giving the trade more room to fluctuate. A tighter trail is on the smaller time frames, and you're securing profits quicker, right? So off the 5-minute, the original stop is right here. Then you would lower it to here. Then you would lower it to here. Then to here. Then to here. Then to here. And then you would lower it to here, and you would have got stopped out on this green bar. But I guarantee by going 5-minute bar by bar versus 15-minute bar by bar, you're actually securing more profits because you're doing it on a smaller time frame. And you could even do the same on the 2-minute chart or the 1-minute chart, right? This just makes sense. So depending on the time frame that we choose, it's going to impact what our management is going to be. Let's look at the next setup here. This is also from this past week on the EME and the ME, okay? Just really nice uptrend, respecting the 20 MA here, respecting the 20 MA here, 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 here. We got a gap up, right? We closed the previous day here. We gapped up right there. You can see the overnight change in price. So bullish gap, right? It's continuing this trend higher, okay? We go to the smaller time frames for a potential setup. So this is the 5-minute time frame, okay? And this was the 15-minute time frame. So let's say we're taking a trade off of the, actually, let's say we're taking a trade off the 5. Let's say we're taking this as a buy setup right here, right? We have a move up, it retraced. We have a buy setup retracement pattern. What is a buy setup? That is a retracement within an uptrend, right? Keep in mind, it's a daily uptrend and it's a bullish gap up. Since it's a bullish gap up, that gives us a bullish bias on the day. So it's a buy setup. It's a retracement within an uptrend, right? Entry here. Let's say stop loss below the lows of the retracement. It starts to move up and it consolidates, and eventually it sets up as a potential breakout. What can you do? Well, as it's starting to break out here, you could actually add to the position, or yeah, you could add to the position and then raise your stop loss to here or even here, right? Or you could just raise your stop. You could just raise your stop loss to that low right there, right? So if you look at the 15, right? If you trade this as a breakout entry here, and you could put your stop loss there, you could put it here, and you could put it there. This is a really loose stop, meaning like you're giving the trade a lot of room to fluctuate in an attempt to capture the move higher. But when you have a looser stop, you have worse reward to risk because you can't get as many shares since you have a wider stop. But if you have a tighter stop, you have better reward to risk because you can get more shares on your position. I would watch the risk management video in my free course or some of the videos on this YouTube channel that go over risk management, and it'll explain the way you could size your positions. But okay, let's say it triggers, it starts to go. It moves up, forms a pivot, and then continues higher. Great, you could actually raise your stop loss, let's say from this point right here. Perfect. And then let's say as it's continuing in your favor here, you just go bar by bar. And now you did pivot, trailed it to this pivot, and then you went bar by bar. And now you go bar by bar here, then raise it to there. And then as this one finishes, this one begins, you raise it again. Then this one finishes forming, and this one begins, you raise it again, and again, and then again. And then right here is where you would have gotten stopped out because this bar took out the low. It took out this 15-minute bar's low, and as a result, you're out of the position. You could have also done it 5-minute bar by bar. But if you did a 5-minute bar by bar, you would have probably gotten stopped out like even here, or definitely here, because this bar took out this low, right? So it's a balance. You have to figure out which time frame you want to do it on. Next, we have the Comcast. This was a bearish gap down from last week where we gapped from here to right here. We kind of gapped below this pivot. We did have a ton of support to the left. So I wasn't in love with this gap, but nevertheless, it did produce nice follow through. So gap down, bearish bias. Fantastic. We don't have an amazing setup here, I'll be honest. In the morning, we don't have an amazing setup, but I just want to use this more as an example. So we have actually here the 15-minute time frame, the 5-minute time frame, and we also have the 1-minute time frame. So let's do off the 1 minute because we haven't looked at a 1-minute chart quite yet, right? Let's say you got in, like hypothetically, you got in here, stop loss over the highs because you really liked the bearish gap and you wanted to go short. It starts to move in your favor, it retraces and then moves lower. Great. What you could do is you lower your stop from this point to right here. Boom. It moves down, right? It moves down, retraces, moves down again, continues that downtrend. You lower the stop from here to over here. Same thing right here. Lower the stop again. Same thing right here. Retraces, moves lower. Fantastic. You lower the stop again until I would say probably like this point maybe. And then in that case, you would have gotten stopped out right here, but you would have captured a majority of the move. So that's one option you could have done, right, off the 1-minute time frame. The other option you could have done is you could have done 5-minute bar by bar, where let's say the original stop is like right here, right? You go 5-minute bar by bar, you lower to that high, then to this high, then to this high, then this one finishes forming, this one begins, you lower it again. This one finishes, you lower it again. This one finishes again. Again. This one almost took out the high, barely did, so that's our new stop. Boom, and then you would have gotten stopped out right here when this green bar formed, right? So whether you did it off the 1 or the 5, it would have probably actually led to the same result. But nevertheless, you would have stayed in the trade. Even here, we have an entry long, right? Big move lower, beautiful doji kind of bottoming tail, almost kind of extended. The trend was exhausted. Plus, we gapped. Remember, we gapped into support. So this kind of like swept the lows, swept this support, and then it bounced right back up, right? And in that case, entry over this entry bar as a reversal, stop loss below. Let's say you went 5-minute bar by bar as a long. You raise your stop to here, then to here, right? It never took out the prior low, then to here, then to here, then to here. You could have gotten stopped out right there, kind of barely. So sometimes what I suggest is give it a little bit more room. Like this is starting to consolidate. Use a wider stop so you don't get shaken out. And then boom, green bar, right? Raise your stop here, raise your stop here again. And then on this red bar right here, you would have gotten stopped out. But that was basically target. You basically got this entire move higher by going 5-minute bar by bar. You could have even done it going 15-minute bar by bar, right? It's here originally, then here, then here, then here, and you would have gotten stopped out there, right? So the purpose is to show you how you could do this on multiple time frames and the implications those time frames are going to have on your management, where you can clearly see that doing it on the 15-minute time frame, you're giving the trade more room to fluctuate, more room to breathe, in an attempt to capture more profit. And on the smaller time frames, you're securing profits tighter. You're not giving the trade as much room to fluctuate. Okay, fantastic. Now that you have those strategies kind of equipped in your trading toolbox, let's talk about creating a trade management plan. And by the way, I have a whole video on this YouTube channel that talks about creating a trading plan, and I really go in depth with this stuff, but I did include some in this video as well. So trade management. Before you enter a trade, you know exactly how you're going to manage the trade before you enter it. You know what your targets are going to be. You know where you're going to take profits. You know how much profits are you going to take. Are you going to take, like in this previous example, right? Let's say like on this trade right here that we just discussed. Let's say, let me shift it lower. There you go. Let's say this was your target, right? and it dropped and it hit your target and you got out 50% of your position, and then you have the other 50% in the trade, right? It starts to come in again. That's when you lower your stop to right here on your back half of your position. And then you manage the back half using the pivot strategy. Does that make sense? So you have to know, like, how much profits are you taking? 50%, 25%, 75% at target one. So how much profits are you taking? Are you leaving a runner? Exactly what we just talked about. When are you going to raise your stop loss? Are you going to do 15-minute bar by bar? Are you going to be doing the pivot strategy? Are you going to be doing 5-minute bar by bar? Are you going to be doing 1 or 2-minute bar by bar if you're looking for a really tight trail? Let's say you're at like target 2. The trade is approaching target 2. You're up 5-6 Rs, right? If you're up so much, you're probably going to want a tighter management. You're probably going to want to secure your profits quicker. That's when you do 1 or 2-minute bar by bar, right? You have to have all these things figured out. And once you're experienced, like once you're at my level, guys, or I'm 5 years into the game, you know what I mean? My decisions are a lot more discretionary, where I'll decide when I'm in the trade based off just my intuition and based off like me taking that similar setup hundreds of times, right? But when you're a beginner, you want this entire plan to be a lot more systemic, to be a lot more predetermined, where you almost have a sheet on exactly what you do, right? And what I would recommend for you guys is take like 50 to 100 trades and manage it with a specific predetermined plan, right? So let's say this is our predetermined plan. I have like a sample plan for you. Let's say it's not at 2-to-1 reward to risk. You stick with the original stop loss. Great. You hit 2-to-1 on your trade, hit targets 2-to-1. You take 50% profits, move stop loss to break even, and then or you trail the back half 5-minute bar by bar. That's like a predetermined setup, right? Hits target, you're out half of the position, back half 5-minute bar by bar on your management. Great. Let's say it exceeds 2-to-1. Let's say you're at 3-to-1 R to R. You take another 50%. So now you only have a quarter left in the trade, and you trail the rest of it super tightly. You manage the rest of it super tightly, 2-minute bar by bar. Let's say you're at 5 to 7 Rs. From there, you take profits no matter what, or you do 1-minute bar by bar, right? You do really tight trail. Another thing you could put in is if the trade triggers, but it doesn't give you follow through, meaning like, let's say you have like a consolidation like this, right? And let's say it triggers you in, but then ends up continuing to chop. From there, you could raise your stop loss quickly so you can get out of the position without incurring a big loss, right? Ideally, you want when you have an entry, you want it to trigger in your favor. You want to see like a push on your entry. You want to see the setup trigger. You don't want to see it hit your entry and then like chop around. You want to see a real trigger, like it actually like hit your entry and then move in your direction, right? So let's say that doesn't happen, it starts to chop around. You could look to raise your stop and trail tightly, right? Let's say you have a really high conviction trade. You know this is going to go higher. You found a perfect setup. You know it's going to hit big targets. You do looser management. You do 15-minute bar by bar. You do a pivot strategy on a larger time frame, or you do hourly bar by bar. Or if you're swing trading, you're doing daily or weekly bar by bar. You're giving the trade a lot more room to fluctuate. And if you have lower conviction on that trade, you do tighter management. You go 1, 2, 5-minute bar by bar. So you need to create a plan. This is just a sample plan. This isn't like me telling you do this. Like you have to come up with your own plan. That's what makes trading so interesting. It's because everyone's a little bit different, right? So take like 50 to 100 trades with your sample management plan. If you want, you could copy this, right? And once you take your 50 to 100 trades, from there you journal. You journal what's going on in your trading. You're journaling how much profit are you leaving on the table. Are you managing the trade too tightly? Are you managing the trade too loosely? Are you leaving profit on the table? Are you getting out way too early? Are you getting out way too late? Notice what's going on in your trading by taking a sample size of trades. And from there, through journaling, you know what to fix in your trading, what to refine in your trading. Let's say 5-minute bar by bar is too tight of management, right? And you're leaving a lot of profit on the table at 2-to-1 R to R. Great. You change this to 15-minute bar by bar. And you essentially manipulate your plan in a way that suits your trading and suits what's working and not working for you as a trader. And you have to notice, are you leaving a lot of profit on the table? Are you not getting out quickly enough? And find out what's your issue and then adjust your management based off of that issue and based off all the strategies that I discussed in this video. All right, guys, so let's do a quick little recap here. Trade management is incredibly important, guys. Ultimately, it's the difference between you being, you having amazing entries and you making money. That in-between step is trade management. You could have the best entries in the world. You could be the best at picking setups. It won't matter. You won't make any money if you don't have a good trade management, right? All these common mistakes that we talked about happen because you don't have a system. You don't actually have a repeatable edge. What you're doing is you're entering and exiting randomly, right? Always keep in mind you have to respect your stop. Always get out your stop loss. And then when it comes to having a winning trade, right? You have these strategies. You have this pivot trail that you could use on whatever time frame that you're looking at. You have the bar by bar management style. We went over exactly how that works, exactly how bar by bar can differ based off what time frame you're looking at. And the real art of all of this is knowing when to give the trade more room versus when to secure profits more quickly. If you want to secure profits quicker, well, you use the smaller time frames to trail your position. If you want to aim for a bigger target, you use a looser trail. You use the larger time frames for your management. Does that make sense? So this is where trading really becomes an art and everyone's a little bit different. But based off of your management style, it could be the difference between you making a ton of money on a trade and you not making money at all. So you need to focus on this. It's incredibly important. All right, guys, I hope you found tremendous value in this video. Like I said, make sure you start watching my free 10+ hour course. It's genuinely better than most paid courses on the internet. I also do free live trainings, free classes where I'll come on live and I'll teach a class and I'll answer questions around once to twice a month. So you might see that in the description of this video as well. So feel free to sign up for my free live training. I usually do it on Thursdays at 6 p.m. Eastern, or if you're already in my free course community, you can actually sign up for my free live training there. Regardless, I can't wait to see you on my next YouTube video. Thank you for watching. Hopefully you found tremendous value. Subscribe, like the video, leave a comment on your feedback, and I'll see you guys on the next one. Thank you so much.